Welcome to the High Rise Podcast, presented by Headset, the leading data and analytics company for the cannabis industry.
Welcome back to the High Rise, a laid-back, data-back conversation where we talk all things cannabis, from Canadian LPs to U.S. MSOs, products and market analysis through the lens of data. My name is Cy Scott with Headset, and I'm joined as always by Emily Paxia of Poseidon.
Hi, everybody. Welcome to the High Rise.
And today we have our quarterly Matt McGinley Power Hour, where we're definitely going to be talking about U.S. MSOs. Welcome again to the High Rise, Matt, a managing director at Needham Company. Thanks for joining.
Yeah, thanks for having me.
Great. Well, another quarter on the books, and we're here recording at the end of March, and I think this stuff all kicked off the first day of March, the earnings report. So we've got a full month to go through, but maybe we start with just some of the broader kind of industry, macro, what you're seeing, what's going on out there, and then I think that'll feed into a lot of what we're going to talk about in these different companies.
Sure. So, look, from a macro standpoint, I think the U.S. economy is holding in reasonably well despite a number of negative things that are rising to the surface. One of the big economic headwinds for the last 18 months or so has been the high level of inflation. Those headwinds peaked in the middle of 22 at around 9%, and that's dropped to around 6% in the latest readings. So it's moving in the right direction, which is down, but the Fed targets a 2% rate. So inflation is still about 3 times higher than where those policymakers would like it to be. And the ability to push down inflation might have become a little bit more complicated with recent issues in the banking sector. Overall, Americans accumulated what economists refer to as excess savings during the pandemic in 2020 and 2021, as people were spending less on travel and clothing and gasoline and so on. And then last year, as things slowly turned to normal with life and spending patterns, we saw inflation surge that was far in excess of wage growth. Asset values and housing and stocks declined, and jobs in interest rate sensitive sectors like housing and tech and cannabis, they all declined. So in total, there were these $2 million in excess savings that was built in the prior 2 years, where more than half of that was depleted over the course of 2022. And by the back half of this year, those savings will largely be gone. Now, that's important because consumer spending is about 70% of GDP in the US. And lower household incomes spend much more of their income on things like housing and food, and those savings were largely depleted a year ago. But among those higher household incomes, which make up a larger percentage of overall consumer spending in the U.S., we'll see those savings largely depleted, or they could sit on those savings because they're concerned about the economy and will not deploy those savings. So that excess savings depletion with that stubbornly high inflation that the Federal Reserve is addressing with interest rate hikes to push down inflation means that there's these economic storm clouds they're pretty visible on the horizon, and it's been difficult to predict when that storm in the form of a recession will arrive. But this economy has kind of been in a state of the storm is right there for over a year. And we may hit that point at some point in 23.
I also think that was coupled with the circumstances and places in which you can consume cannabis. So while also you saw the ability to, your savings increasing during a time when you could stay home, Netflix and chill and consume cannabis, people were going back to places where you actually go into a bar and you by nature cannot consume cannabis in a bar in most places. You can't consume cannabis on an airplane or in a hotel in Europe, technically speaking, or at least any that you're buying from any of the operators in the United States. Now, that's a technical thing, but it's just something I think coupled with, spending constraints is like behavioral circumstances that kind of potentially could decrease the consumption of cannabis in those environments.
Yeah, I think that's right. And as it relates to the cannabis industry, I think there's probably a few observations to note aside from funding, which we'll talk about in a minute. But, the macro, as I said, is not favorable. I suspect a lot of the trade down in price points from mid-tier to value was related to the economy. And what I noted with lower income households before not having much in terms of savings, and inflation has reduced their disposable income. I'm not sure the trade down gets worse this year, but I don't think we'll see trade up. Price compression overall has been a pretty consistent headwind. Wholesale and retail price declines were worse in the Western U.S., but cannabis prices were down in Eastern markets as well, with states like Michigan and Pennsylvania and Massachusetts seeing pretty substantial declines. We're seeing some indications of stabilization as a result of a reduction of the number of growers and the amount the growers are producing. I would say thematically that's probably a little bit more in the Western U.S. than perhaps in the Eastern U.S. But as I said before, when I've been on this podcast previously, when you're selling a deflationary product in an inflationary environment, that is a really tough thing for margins, and it's hard to manage that. Then compounding that, you have a lot of competition, and it's not state legal operators definitely compete against one another, but the increased level of competition from the illicit market and competition for things like Delta 8 has certainly grown substantially in the past year.
Yeah, and that does create consumer confusion, I find, in the markets where Delta 8 is really thriving, is that people don't really understand quite the differences, which is interesting. The wholesale piece, I definitely found that to be an interesting trend across all of the operators. It's something I've been watching for a long time now, just having spent time inside of some of these operators and understanding the pressures that come and how it's uniquely dynamic, depending on market constraints such as retail caps and sell through on the vertical, various things like that. And then also looking ahead to what would happen with Illinois when we knew Missouri opened, although I think Missouri opened faster and more furiously than anybody had planned on. And that's something we'll have to keep an eye on in terms of what that changes in consumer trends coming from other markets. But these are all things that as every market opens, we get a little bit wiser on how to look ahead and look around corners and think about it. But on the pricing side, I think while it's been painful, I think this is going to be kind of a crucible for discovery on where we're going to net out as an industry, and in terms of consumer products and tiering of products and pricing of products, and thinking about different market segments that the category attracts and connects with. So interesting time, a difficult learning environment for sure. But I think those are some great themes, Matt.
So when we look at the overall growth of the industry, in 2020, the industry grew 50%. In 21, it grew about 30%. And then last year, it was around 4%. And that 4% growth was driven primarily by markets that were east of the Mississippi that continued to grow, which was offset by double-digit declines in most of those Western markets, with the exception of new states that came online like New Mexico or Montana that just launched their adult use programs. So into this year, we think the growth will probably be around 8%, with much of that growth being driven by those new adult use markets or continued ramp in those East Coast markets like New Jersey. Connecticut and Rhode Island are new. Maryland will likely be open in the back half. I don't know how much growth we're going to get in New York, but then, to your point, like Missouri opened up very quickly, and that will likely, drive the overall growth rates higher for the industry. I think those West Coast markets will probably be down again this year just based on where pricing is at, but I doubt those markets will be down at the same pace as we saw last year.
How much of that is 2022 kind of coming off of 21 or like 2020 with such high sales ramps in the COVID times, and then 2022 obviously when you look at growth versus 21, because 21 was still we were still kind of in the midst of it, right? That everyone had the savings, inflation wasn't out of control. Do you think we're at the point now where and 2022 to 23 is going to be pretty comparable, when we look at the fast forward to the end of the year where it's kind of apples to apples a bit more than maybe 22 versus 21?
I think it'll be more so, but remember that higher pace of growth in 2020 and 2021 also had a lot of market development and new markets that opened up. That was the growth rate significantly improved because you had people that were staying at home and likely consuming more of that. So yeah, I think we probably are at more of a base level in 23 that will probably be more comparable to 22. But remember that pricing pressure is still going to be there, and so that is a drag overall on growth rates.
Yeah, and I know we'll get into the companies here, but just in kind of a macro sense, how much exposure from these new markets like Missouri that are doing pretty well for like new adult use markets where some growth may be coming from this year. How much exposure do some of these have? Like New York, it's like non-existent right now with the conditional adult use dispensaries that are popping up, right? and medical. I mean, unless, that lawsuit goes through and something happens towards the end of the year for New York, it just seems like that if New York is going well, the companies we're talking about today don't really have much exposure there. But other areas, I mean, Maryland, certainly, if we see something. But do you have any sense of how much of that macro is going to drive some of it?
Missouri is virtually no exposure for public operators. New York, those operators have not been able to participate in it. There is public operator exposure in Connecticut and Rhode Island. Most of the MSOs have, I should say all of them, but many of them have operations in Maryland. And then, New Jersey will continue to be a driver of growth. So there's a decent amount of exposure to those states that will have, there will be a bigger component of the growth this year.
Yeah. So that you were thinking 8% this year versus 4% growth last year, but that additional 4% that we might see in 23 might not be reflected very heavily if it's just Connecticut and Rhode Island for some of these names.
Those are smaller states. Yeah, for sure.
Cool. Okay. Anything else on the macro side you want to touch on?
I think maybe we'll touch on the funding and maybe we'll talk through, some of the trends we saw last year. So the funding outlook, frankly, is not particularly good right now. Capital raising activity was down 65% last year.
Wow.
Equity financed activity declined by 75%, and debt financed activity was down by about half. And then into this year, the capital raises are again down by about 50%. Now, part of that decline is driven by changing perceptions of risk in the capital markets, and early stage companies that don't often generate cash just become less preferred and less valuable in an environment like this. But also fundamentals got worse. And just the fact that we've had no movement on anything at the federal level, and the inability to pass any legislation there, just it creates a host of issues around custody and clearing of equities. And there are very few banks that are willing to offer even basic depository services, let alone offer loans to cannabis related businesses. And I would never say that safe banking was going to be a panacea, but the failure to advance even the most simple of banking reforms, I think just shows in Washington this is not a priority, or there just is not the political will to advance reform. And I suspect that the timing of the HHS and DOJ review of where cannabis is scheduled will probably be driven by political considerations and not practical ones of when they have the available information to make that determination. But with capital markets access likely to be tight, there are probably going to be business failures in this space this year and the next year. And the inability to raise capital is also likely to have a negative impact on states that have prioritized social equity licenses in their programs. That's yes. Very true in New York, where much of the operational retail or cultivation infrastructure to stand up the program isn't there, and the medical operators can't participate. So standing up that program will likely be difficult due to a lack of capital, and it'll take time. Retail addition in New Jersey will be slow to build, although there's more operational capacity in there. So I think that will be a higher growth state than New York will be. And then in Illinois, I think it'll take quite some time to open up all 192 of those dispensaries. I would venture a guess we will probably have less than 50 of those that wind up getting open this year. And then in Maryland, they're prioritizing it too. But I guess the one thing about Maryland is that they are probably in better shape because they already have over 100 medical dispensaries and a decent amount of cultivations there. Although the bill that the legislature passed limits operators to 2 dispensaries, so we'll see how that what they actually come up with when the final rules are complete. But that might drop from 100 dispensaries to 50 to 75 when that program opens. But that lack of funding is really going to hurt growth.
Yeah, I think that's all very right. I mean, I did hear a theme from some of the more established operators that CapEx is substantially behind them. So they're just thinking about being as efficient as they can for as long as they can, but all the while knowing that the 280E continues to wreak havoc on their business. And especially as you see the margins compressing, it just gets harder and harder. And I think, to your point too, on the equity piece, like, just looking through to the downstream effects of these license caps and not thinking about what the long-term view on that is. And we're starting to see distress in, for example, the cultivation side in Massachusetts of operators who essentially basically overbuilt and can't sell through enough capacity to make it work anymore. And until some things like this change, you're not going to see a lot of funding of these equity applicants because there's no path. And I hear it from the equity applicants too. So hopefully we'll see some rational thinking there. But I do think that, the federal government basically put the industry in a penalty box on a capital and a funding standpoint. And it's too bad because it's really at a stage in the life cycle where we should be able to drive more innovation and growth. But we're just going to have to be a slave to cash flow at this point and get there through that.
Yeah. That is right. And that is, I think, the key point. The single most important operating metric and most important deliverable for any of the public operators in 2023 is cash flow generation.
100%.
They need to continue to get tighter on operating costs. They need to manage inventory well to support gross margin. They need to get tighter on working capital, and CapEx needs to come down materially. Now, the debt maturities, I guess the one good thing is that the debt maturities for the majority of the bigger operators are not really an issue in 2023. Most of those companies have pushed those maturities out to 24 and 25. But if a cannabis business does not have a business model that can generate cash flow and prove itself to be self-sustaining, it will be probable that that business will fail because it will be difficult to find the additional capital to fund the business if it isn't self-sustaining or doesn't have visible prospects of being self-sustaining. I don't want to sound so absolute,
Right.
but like if it doesn't look like a business that can sustain itself with cash flow, then it's unlikely that they will get funding. So that's a really, really, and when we talk about the companies, you'll hear that time and time again. Like it's extremely important that they get the cash flow up this year.
Couldn't agree more.
So why don't we talk about the operating fundamentals overall, and then we'll start to dig into the individual companies.
That sounds great.
So in 22, the average revenue growth among the top 10 MSOs was around 17% versus the industry, which grew 4%. Now, those public operators generally have more limited exposure to Western markets that were down, and they also had M&A, which would make their growth rates higher than the overall industry. If you think about these businesses simplistically, like you have a wholesale business and a CPG business or a retail business, and then you have the wholesale business. And in terms of segment level growth for the MSOs, the retail has been almost all of that growth. Retail was up around 26% last year for those MSOs, while wholesale revenue declined by 8%. And that decline in wholesale is exacerbated with price decline because price declines more in wholesale than it will decline in retail. But with more product being produced and then sold through company stores, that also hurts the size of the wholesale businesses. And I think that says a lot about the strength of the brands and how much brands matter at present. The fact that that's shrinking, and where the real value of these companies are today is primarily in the retail operations.
I agree. And you can see it so acutely in certain markets, like when we look at Massachusetts, going back to Massachusetts, just watching what has gone on the wholesaling there is just, it's incredible.
Yeah. So last year, the average operator had about a 5-point decline in gross margin, and that dropped to around 49%. That was down on price compression and in some instances on inventory reduction. And as that wholesale volume declined, the cost per unit generally goes up. But there's also inflation in packaging and utilities and labor costs. And based on where the companies ended the year at, and with the expectation that we'll continue to see prices slip this year, gross margins are almost certain to be down again this year. Now, operating expenses, those are retail store expenses and corporate expenses and advertising, which are all non-deductible under 280E. On a year-over-year basis and on a rate basis, those expenses went up a little bit, but because most of those companies added stores, this got a little bit better as the year went on because most of the companies shrank headcount in corporate and in retail. But as pricing falls and gross margin declines, this is a key offset to that, where they need to get tighter on the operating expense to keep those margins fairly steady. EBITDA is a kind of a useful but very flawed statistic that we use to measure the operating profitability of the business. It's flawed because when it's not all the adjustments that are made to it are consistent or the same across the companies, and it's a proxy for cash flow generation, but it's a very poor one because the taxes that these companies pay, it's very high, and it doesn't account for differences in capital structure. So if a company uses a lot of sale leasebacks, those rental expenses will make the EBITDA look lower. But if they issue debt and they pay a lot of interest, that wouldn't reflect EBITDA at all. So while it's a flawed measure, we use it to look at, like I said, the operating profit and the operating efficiency of that business. So among the top 10 MSOs in 2022, revenue was up 17%. Where would you guys guess that EBITDA was at if revenue grew 17%?
So what do you think?
So I would say right in line with that.
It's flat. Dollars were
Yep.
flat. And it was flat because the margins contracted. They came in about 4.5 points. So the average company in 21 did about a 30% EBITDA margin. And at the end of last year, that was around 25%. So that's, not moving in the right direction. But I would say that generally these statistics improved a little bit as the year went on because of the cost cutting. And then cash flow from operations, which is a much more tangible
Yes.
and important metric than EBITDA, because this is looking at like how much cash the business generated from operations, inclusive of interest and taxes and investments in things like inventory and changes in things like payables and receivables. That metric can also be distorted by deferred tax payments, which we'll talk about when we get to Verano, but only half of those larger MSOs last year generated positive operating cash flow. And then when we take into account capital expenditures, so the spending on store openings and cultivation facilities, none of these companies generated free cash flow last year. Every one of them burned cash or consumed cash from operations and investments in the business. Now, the rate of cash burn, like I said, did look a lot better in the back half than it did in the front half of the year. And even if margins slip and growth slows in 23, cash flow will probably look better because there's less investment going into the business. CapEx, to your comment before, Emily, CapEx was about $950 million amongst those bigger MSOs last year. That will probably drop by around 2/3 this year. And because the pace of expansion is slowing, there's less working capital investment. So that operating cash flow and free cash flow will look better this year. And as I said, and I'll say it again and again, that is the key deliverable and focus area for these companies. And I don't want to sound dire, but if they can't prove themselves here, it's an existential issue. Cash flow is very, very important right now.
Yep. Yeah, we used to be really focused on EBITDA about a year ago, and then it's been focus on cash flow, because if you can't in this funding environment, it's really what has to happen. The other thing that was a theme, and I did kind of want to do a tally on it, was the amount of goodwill write-downs across every single organization and the shedding of assets. I kind of want to just in a learning experience about allocation of capital over these years and thinking about who's been the most efficient is just one of the things I want to dig in on a little bit more.
Yep.
That's just a sidebar. Thinking about CapEx.
There were definitely a lot of impairments this year in the fourth quarter.
Yep.
So why don't we roll into the
Let's do
company?
it.
So why don't we we'll go Green Thumb, Trulieve, Verano, and then we'll do Cresco and Columbia Care together. And then we'll wrap it up with Air, TerraSend, and Ascend.
Great.
Works for me.
Great. So Green Thumb, they remain, I think definitely the best operator among the MSOs. They have been very good with working capital management. They have been very consistent with cash flow generation, and they did a very good job in managing expense in 22 to offset price compression. Now, for Green Thumb last year, they grew revenue 14%, and they generated over $1 billion in revenue. Most of that growth for them came from New Jersey and from assets they acquired in 21. But with pricing headwinds, they did have offsets to growth in states like Nevada, Pennsylvania, and Massachusetts. So despite that 14% revenue growth, EBITDA only grew 1% due to margin compression, with their gross margin dropping about 5.5 points to just under 50. Now the offset to that was they were pretty tight on their management of operating expenses, with their kind of core G&A dollars getting a little bit more than a point of leverage. But on that gross margin decline, their EBITDA dropped by about 4 points to 30%. They generated positive cash flow from operations for all three of the last 3 years. Last year, they did $160 million in operating cash flow generation, which is outstanding, especially in light of the fact that they actually did invest about $70 million in working capital, and they are current on paying their taxes. They don't do the deferred tax thing. So that cash flow generation that they have is actual real, cash flow generation. And we'll get into this with Verano, but many of the MSOs will elect to defer tax payments because the penalties they pay with the IRS are lower than what the funding costs would be if they used other short-term funding sources like a revolver or a construction loan. But CapEx has still been really high for GTI. On a cash basis, they spent about $180 million last year. And on a gross basis, if you include the sale leasebacks that they used, they spent about $240 million. So when you look at them on a free cash flow basis, they were slightly negative last year with about a $20 million burn. But for the outlook for this year, New Jersey will still provide for growth. They have exposure to Connecticut and Rhode Island. Those states converted to adult use. Maryland will be hopefully operational in July. And then they continue to build the medical program in Virginia and in Minnesota. Those will all be drivers of growth for them. But, like I said before, I think the headwinds they saw in Pennsylvania, Nevada, and Massachusetts will likely still be there this year. The one concern that I have for all the operators with big Illinois exposure, and that's Green Thumb, that's Cresco, that's Verano, Curaleaf, Ascend, is that wholesale pricing had been fairly steady in Illinois up until late last year, and that has come down quickly. For GTI, I would guess probably about a fifth to a quarter of their revenue comes from Illinois, and probably a third-ish, maybe a little bit less than that, of their EBITDA comes from there. So, if the margins really begin to come in Illinois in general, we could see a faster rate of margin decline for them. I want to call that as something that definitively that's going to happen immediately, but that is a concern into this year is sort of what happens in Illinois in terms of pricing. For this year, I think GTI will probably grow their top line between 5 and 10%. I think the first quarter will probably be down a few points, and I would expect gross margin to be down a few points. So again, managing expense is going to be critical to keeping those EBITDA margins up. The operating cash flow this year will probably be higher as long as they continue to manage that working capital well. And CapEx is dropping. I think their guide is for 110 to 120 million. So they will very likely be free cash flow positive this year. They have a $250 million loan or debt that comes due in 2025. They ended this year with 175 million in cash, but they're really the one that you look at right now and you say they're really at a point where they are probably capable of self-funding growth, and they have the capacity to retire that debt if need be in 25 rather than refinancing it. So, Green Thumb will have pressures this year as all the operators will, but I think they're overall in the best shape.
And you would consider them to have the best balance sheet out of the companies we're going to talk about?
I would. Yep, I would. And especially when you take into account the fact that they have, they're current on their taxes.
Yeah, it's funny because I mean, we have talked about how the most affordable lender is the federal government on this in terms of the structures they put in place around paying these things down. But it also feels like for a group like GTI who's been staying current, it's like good for them to be focusing on running the business without having to take that. But yeah, it's interesting.
Talk Trulieve?
Yeah, let's do it.
Yeah.
So Trulieve, yep, they are. So Trulieve is by far the biggest operator in Florida. I would estimate they're probably about 40% of the revenue from Florida's around probably $2 billion cannabis medical cannabis market last year. Trulieve has a very concentrated revenue base where probably about 60% of their revenue comes from Florida, and probably about 30% would be split between Arizona and Pennsylvania. So because almost all that revenue comes from those three states, and I don't expect those states to have much growth this year, I think their top line will likely be challenged this year. So Pennsylvania as a medical market is rapidly closing on the cap on the number of dispensaries that are allowed in the state. Prices have come down, and the market likely has limited growth in terms of its size until the point that it converts to adult use. Arizona converted to adult use a few years back and also has a cap on the number of dispensaries that are allowed in the state. And while the retail productivity is really still quite strong in Arizona, those prices continue to come in. And I think that market probably shrinks this year. In Florida, I would expect the market overall would probably grow this year on a dollar basis, but it's probably going to slow based on the rate of patient addition. There's already 800,000 people on the medical program in Florida that have medical cards. The next major catalyst in Florida will be adult use conversion, which will be on the ballot in November of 2024. If it passes with 60% of the vote, that market would convert to adult use in mid 25. Now, Trulieve has put up, I think, $30 million to get the signatures collected, to get that reviewed by the Florida Supreme Court, to get that on the ballot. But none of the other operators are putting up any money to do that. And frankly, there needs to be a substantial amount of marketing that goes into supporting that, to make sure that people get out and vote for that in 24. Or I would say that ballot initiative risks failure. Now, Trulieve definitely has big market share in the state. They would benefit the most from this, but they're really doing all the heavy lifting on advancing adult use conversion in the state. And, it kind of takes a village, and there ain't a village there right now that's trying to move that forward. Now, Trulieve will have a little bit of growth. They have a dispensary in Connecticut that converted to adult use. They might get a little bit of benefit in the back half from Maryland as that converts. And, they do have assets in Georgia and West Virginia, but those are generally small. But with limited market growth in Florida, Arizona, and Pennsylvania, I think the overall, revenue growth for Trulieve in 23, based on its geographic footprint, is probably pretty limited. They grew their revenue last year 32%, but a big chunk of that was they closed that acquisition with Harvest very late in the year. So when you look at the full year numbers, they're not really comparable. But when you look at the fourth quarter compared to the fourth quarter, which is the first kind of apples to apples, comparable quarter, the fourth quarter revenue last year was slightly over $300 million, which was just a little bit below what they did in the prior year in fourth quarter of 2021, despite adding 14% retail unit growth, or around 22 dispensaries that were added during the year. Now, Trulieve always had a smaller wholesale business compared to other MSOs because they're anchored in Florida, and Florida is a state where you have to be vertically integrated. So wholesaling doesn't really exist there, with few exceptions. And most of that wholesale revenue for them comes from Pennsylvania and Maryland, but their wholesale segment dropped from about 9% of their total revenue in the first quarter down to about 4% by the end of the year. And their adjusted gross margin declined by about 5.5 points to 54% in the latest quarter on price decline and selling off inventory in those states related to their wholesale business. They've done a pretty good job, I think, of managing their G&A costs by cutting at corporate and gaining retail efficiencies. But like I said, they added 22 stores, so the dollars aren't really dropping that much. And when you look at it in total, the EBITDA rate last year dropped, or I should say, let's do it on a quarterly basis. It dropped from 33% in the fourth quarter of 21 to 28% in the fourth quarter of 22. And their overall EBITDA dollars during that time dropped by around 16%. So with that margin decline and the store additions, it did hit EBITDA quite a bit. Now, in 21 and 22, Trulieve built this very big new cultivation facility that will likely be about 4 times as efficient from a labor utilization standpoint as the facilities that they use right now. That facility is ramping up, but as that facility is ramping up, they built a lot of safety stock and inventory to help manage that transition. Now, last year, the company, on an operating cash flow basis, only generated $23 million in operating cash flow. And the big drag for them was about $80 million in inventory investment. So when we look at 23, they expect to add 15 to 20 new stores, or about 10% store growth, which will likely provide some offset to the price compression and perhaps keep retail revenue relatively flat. The wholesale business at 4% of overall revenue, once you kind of hit the floor, there's not much further to go. But when you look at that on a year-over-year basis, that will probably be about a $30 million year-over-year drag. So I would expect the revenue would be down a few percent this year. But what's an absolutely critical deliverable for Trulieve in 23 is they need to substantially work down those inventory balances. Inventory over the medium term should be probably about half of what they had at the end of the year last year, which is about $300 million. I don't think they'll get necessarily all the way there in 23, but that is a very critical thing for them to get the inventory balances down. They began to deplete the inventory from those older cultivation facilities. That will be at a lower gross margin, and they might cut prices to get rid of some of the older stuff. But as they transition from the old production facility to the new production facility, that should be something that will help boost gross margins and offset some of the damage from price compression. Like I said, revenue will probably be down. They'll add stores. So they'll need to find efficiencies in G&A again this year to offset the growth that they're going to have from those stores. And if revenue is down a little, gross margin is down a little, expenses are up a little, EBITDA rate would probably be down at a high single-digit rate this year. Trulieve guided to do about 100 million in operating cash flow, compared to the 23 they did last year. But if the operating profit is down, the increase in cash flow needs to come from somewhere else. And I'll say it again, that needs to be working capital, and that needs to be inventory reduction. They spent about 165 million on CapEx last year, and they think that'll be about 50% lower this year. So if they get to the 100 million and their CapEx is roughly 80, they would be free cash flow generative on a full year basis. They have a I think a pretty good balance sheet. They're in good shape. They had 220 million in cash, and again, if they get those inventories down and they generate free cash flow, they would likely be in a pretty good shape to either retire or refinance $130 million in debt that comes due in mid 24. There could be opportunities for M&A, but I think overall the focus on cash flow is ultimately the real thing that they need to do this year.
Yeah, I think this will be the real time to see how they do on the final digestion of the acquisition of the harvest assets, and to your point, ramping that high tech grow they've got in Florida on that side. But yeah, inventory was top of mind when I listened to that call and read through the filings. But we'll see what happens next.
So Florida being completely vertically integrated, I mean, for inventory reduction, that means they've got to sell it themselves, right? So,
Yep.
yeah, is that I don't know. I can load some headset data here on pricing, but I mean, does that just continue to kind of push pricing down? To your point, Emily, like this price discovery, is Florida going to find out where it's at? If they do have to drive down the price, does that become the new price? And then, with that new facility, are the margins good at that new price kind of going forward?
I mean, my 2 cents on spending some time on Florida is that it has been it's been like the war of promotional activity between the biggest operators that have been there for a while. It's like you can't walk 5 steps without getting a ping on a discount or a deal, or come in and get this and that. And but then you've had these like quote unquote higher quality cultivators come into the market, like Jungle Boys. She has Connected as I think her higher tier cultivation. You have like obviously Sunburn, those guys are trying to raise the bar on quality too. And I know they had to work through some MedMen inventory that was probably pretty lackluster, but as we've come to expect from that company. But I think on the sell through on inventory, it's probably going to be a lot of promotional work to get through that, to just kind of drive through it. And then maybe we'll have to hit a reset. But yeah, we should look at the data around it. But I don't know, Matt, are you seeing anything different? I mean, that's just, yeah.
Like I would say that I just think with a larger store base, they should have efficiencies that they will gain in inventory management that other smaller players wouldn't be able to do. So yeah, they'll need to get through the older inventory. But again, as they convert over the newer facility, it should be a gross margin benefit. But they got to work it down.
And then any sense of like the patient count trajectory? You mentioned they're going to do 10% store growth. Does that track with kind of what patient count looks like? I don't really have.
Patient count has been slowing. I have the file. I could open it up, but I mean, they were just. I think they're the latest numbers that were put out. There was 802,000 people on the program. It has just law of large numbers. It kind of gets slower, but
sure.
Florida's a big state in terms of there's 540 I think dispensaries in the state right now, but there's 20 million plus people in the state, and there's probably still some room for unit growth, but with that patient growth slowing, it will make it harder to grow top line.
Yeah, and I guess just to follow up on some numbers, I pulled some Florida pricing and discounting real quick. And looking at February of last year, flower average item price, this is pre-tax, post-discount, was $30. That's across all flower, regardless of package size. And then now it's or February of this year, $24.45. So about $5 difference. And then this one's pretty striking. Discounts. So discounts were at 27.8% in February of last year, and now they're at 40.2%. So almost all of half of flower is discounted right now. Yeah.
There we go. That's pricing pressure, I think.
That is
right.
That's some data. Okay. All right. Shall we keep moving?
So let's go to Verano. Yeah. So Verano, I would say that they were somewhat similar to what I described with Green Thumb, where the revenue grew 19%, but they didn't really have much follow through to EBITDA because of margin decline. Most of the growth for them last year came from New Jersey and Florida and from assets that they acquired in 2021. But they actually did grow their wholesale business by about 9% in 22, and their retail revenue was up 27%. Now, they had gross margins that fell by about 4 points, and their G&A expense grew because they were adding stores, and that caused about a 7-point drop in EBITDA. Now, at year end, they were still at about a 37% rate, which is at the top of the pack compared to peers, and they generate strong cash flow, but there are some distortions in there that I think are worth noting. So on the cash flow, in 2021, they did $180 million in operating cash flow. About 60% of that was driven by deferred tax payments. And in 2022, the operating cash flow was half of what they did in the prior year, about $95 million. But the operating cash flow, all of it was deferred tax payments. So they would have been basically flat or slightly negative if it weren't for those deferred tax payments. Now, there's nothing particularly nefarious about delaying tax payments as a funding strategy. And the reason why a few companies do this is that the penalties they pay to the IRS are usually in the kind of mid-single digit rate in terms of funding cost. And if they were to take out, term debt or use sale leasebacks, that cost would be in the double digits. So, if you had a choice between taking out a loan at 12% or taking out a loan at 6%, I think we would generally agree that 6% is the better option. The only nuance with that is that term debt could be a 3 to 5 year maturity, and sale leasebacks could have like a 15-year term. When they delay or defer those tax payments, that means they drag that payment out for about 12 to 18 months. So it's kind of a short-term solution. And as the rate of growth slows, the growth in that tax base also slows. So it isn't something that's like an incremental funding source that they can carry on forever. It just doesn't get bigger, right? And over time it will probably shrink. Now, if they used a lot of sale leasebacks to fund growth, this company would have lower margins because that rental expense would flow through the P&L and their cash would look worse. If they used debt, they would have less operating cash flow because of the interest expense. But because Verano delays these tax payments, the way it shows up is that it makes their cash look better. So their margins are sort of artificially higher and their cash flow is sort of artificially better based on using this as a funding source. So I think there's probably two key points to make on that. In terms of how the company is valued, when we look at the enterprise value of Verano, these deferred tax payments really should be treated like debt. So instead of having $250 million of debt on the balance sheet, they have $250 in taxes that they owe to the IRS. And whenever they begin to repay this debt at some point in the future, or repay these taxes, their cash flow is going to look not as good. So there will be a reverse to this at some point in the future that will make the cash flow look worse. Now, Verano gave guidance for cash flow in 23. And I should say it's about all the companies. When a company guides cash flow, it's kind of a tricky thing to guide, right? Because not only do you have to be accurate in terms of the revenue, you need to make assumptions on pricing and mix that will impact gross margins. You need to be accurate on the operating expenses and interest and so forth, all down the P&L. But it's also kind of tricky because, it's hard to predict changes in working capital. That's not easy either. And there are timing differences on when they might, get paid for something or when they might pay for something or, when inventory will be built versus when it will be shipped. Those are all things that can be a little bit lumpy. Now, all that said, Verano guided for free cash flow of 50 to 75 million in free cash flow, and they're only going to spend 25 to 50 million in CapEx. So at the midpoint, that would imply that they expect to do about 100 million in operating cash flow, or roughly the same rate that they did or the same range as they did in 22. But what they said was they won't be boosting cash flow by delaying taxes, and they might actually begin to pay down some of those taxes. So a big portion of that cash flow generation for them is going to be in reducing inventory and working capital improvements that will make that look better. So they began to reduce that inventory in the fourth quarter. And as they're cleaning up that excess inventory in a few states, as they did this, their gross margin dropped by about 9 points. And they think that it'll look kind of like that through the first half of the year. So once that's done, they think they could probably get back to towards 60% later in the year. But in the front half of the year, it's not going to look great. And then in the fourth quarter, they also had a benefit from something called an employee retention credit, which I'll spare you the details on that. But basically, this is kind of a one-time item that they didn't really treat as a one-time item. To be fair, they were completely clear about what this was and how they were presenting it. But The 35% EBITDA rate that they reported in the fourth quarter is actually probably more like 30% if you excluded that benefit. So as we look into the first quarter, or really the first half, they'll likely have EBITDA margins that will fall by at least 5 points. But the reality is they already did fall 5 points. They fell in the fourth quarter. Now they're just at that run rate of around 30%, because their EBITDA was around 11 million lower than what they reported in the fourth quarter. And EBITDA for them, the way they presented it, looked like it fell only 4%. But if you strip this thing out, it actually fell more like 17%. So it was a pretty big sequential decline in EBITDA. Now, Verano, I think, will probably have some top line growth this year. Part of that is going to be driven by the full year benefit in New Jersey, but they're also wholesaling in Connecticut. They also could have up to 6 JV locations in the state. They'll see growth from Maryland. They're going to be putting up stores in Florida. But I think their margins are going to be down by at least 5 points on the gross margin. And when you correct for some of that noise around that ERC credit in G&A, actually I think they did a reasonably good job of managing operating expense down. But we need to see a lot more of that in 23 to help offset that incoming pain that they're going to have on gross margin.
This is interesting. Morgan and I have been talking for a while about how they've held on to their real estate, which I give them credit for, because a lot of the other groups have had to turn to the sale leaseback strategy to help fund the business. And to your point, then you have the EBITDA and all the other things that go into it. But as commercial real estate is coming under pressure and potentially seeing that as a solution, although the cap rates may change on the sale leaseback, structuring around this, it's interesting how those assets are potentially not as valuable if they needed to turn to them to create more cash flow in the business. But I don't know. This one's interesting. It's interesting to see this, that the ERC, for once our industry was able to participate in something as a tax benefit, because we were not able to do that on other things like PPP. But I'm glad that we were able to take advantage of that. And I agree with you that, you can use the tax pay down period as a way to kind of, play with cash flow, but just being mindful of what's coming next. And so I don't know, these strategies are one to watch. Tough times.
Yep. So next we'll bucket Cresco and Columbia Care. We'll do it as a combo pack because they're still attempting to merge, although the merger arb spread on that deal has been running at like 60 to 70% for the last month, which that's telling you the market assigns a very low probability that deal gets done. That was always a very complex deal because it required regulatory approvals and a ton of states, and required divestitures in a handful of states. And the last time I think we were on here, we talked about the strategic value of that, or strategic rationale rather, and how Cresco is deep in a few states and they have stronger brands, and Columbia Care is kind of spread thin, but they have a much wider footprint that would provide geographic exposure that would have better long-term growth. But I mean, the challenge with that deal is one, there isn't much capital available for buyers to purchase assets, and then two, if they are able to sell all of those assets, the proceeds on an after-tax basis might not be sufficient to cover the $120 million in non-transferable Columbia Care debt. And I think it would probably cost something around $100 million in cash to fully integrate those assets. So even if they close the deal, they might not have the liquidity, or they would be taking on a lot of operational risk because they might not be able to sufficiently quickly integrate those assets, and they might not be capitalized to quickly integrate those assets. So they have until June 30th to complete the deal. They could extend it again. I don't think there would be any reason why they couldn't extend the deadline, but at some point I think the boards would just need to discuss if it makes sense to keep trying to merge, and if it would make sense to just go on their own ways, because at a certain point there are things that they won't be able to do with their running their businesses that they would want to do as a combined entity, that they need to call it a day.
I've been wondering too why there hasn't. Well, I'm just waiting for the update that the deal is getting restruck, if it's even going forward. I mean, I know it came up on the call, and I definitely heard the response, which I'm sure was a legally guided response because you can't say anything, MNP, but I'm just waiting for it because it's just, I feel like we're living in a reality distortion field from when that deal was struck to today, and the value of almost everything, not just cannabis, but ex-cannabis. It's just a different world today.
It is. That's why I think it'll be very hard to get done. And that's why the market is pricing in the notion that it won't
I
get
agree.
done.
I was listening to both calls and listening, very carefully to the kind of emotive responses from leadership on whenever y'all were on the call asking questions, trying to kind of feel out what I think is happening. I mean, I know what I think is happening, but anyway, interesting times.
So for Cresco in 22, they grew their top line by 3%. All of that was driven by retail growth. They have the biggest wholesale business still, but their wholesale business dropped from around 50% of sales in 2021 to around 44% of sales in 22. So their wholesale revenues declined by about 12%. All of its key operating metrics over the year moved in the wrong direction. Gross profit slipped. They actually did, I think, reasonably good in managing G&A, but EBITDA dollars were down around 10%. And that decline was particularly acute in the fourth quarter, where the revenue dropped by 5%, driven by wholesale decline, and their EBITDA dropped by about a quarter. So pretty steep fall off there. The overall plan for them in 23 for Cresco is to focus on core states, and for them that's Illinois, Pennsylvania, and Florida, and then to rationalize cost in other states. They made pretty substantial changes to their production and distribution footprint in California, and they're closing one of their facilities in Arizona. But they'll have about 30% unit growth, or 30% more stores this year. So they'll likely grow their retail revenue, but wholesale revenues are probably going to be down on price compression. And the new units that they're putting up will be more front half weighted, which will have all the expense associated with those stores and with operating those new dispensaries. So the G&A and production efficiency cuts really won't likely be a big driver of margin gains or cash flow improvement until the back half of the year, when those stores are, fully, ramped and operational. But their CapEx is going to drop by 50%. So, I would expect to see improvement in cash flow generation, but, optimization of that asset base is going to be critical. They do have some payables and debt that comes due in 23, but, their big maturity is in 26. So, they have some time, and, they need to focus on cash flow generation. And they were very clear that is their plan.
With wholesale being so exposed to wholesale, did most of the companies that you're covering here, I mean, generally have a decline in wholesale?
With one or two minor exceptions, I think everyone had a smaller wholesale business this year than they had in the prior year.
Yeah, got it. So just more exposure, just a little tougher for Cresco potentially.
I mean, they've always had the most exposure on wholesale of all of the MSOs by producing.
Yeah. I mean, they're big in Illinois, they're big in Pennsylvania, and they bought those assets in California a ways back. That's not a meaningful contributor now, but
still, yeah,
they're big. And so for Columbia Care, they grew their revenue last year by 11% and their EBITDA by 16%. So their EBITDA margins were up, but it was only up by about 80 basis points, and they only got to 13% EBITDA margin, which is pretty low. That's very low. And similar to other operators, they cut a lot of G&A, but gross margin overall was down by about 1.5 points. The fourth quarter for them was not a great quarter. Their revenue declined by about 5%, and all of that was driven by their wholesale business, which declined by about 30%, which knocked gross margin down by about 5 points to 37%, which again, that's pretty low compared to other operators in the space. Their operating cash flow losses last year were $110 million. They spent $70 million on CapEx, so their rate of free cash flow burn was $180 million. Now there's kind of two sides of the coin there. Like the front half of the year was very bad, and they actually did improve that quite a bit by the time they got later in the year, to such an extent that they actually did generate a tiny little bit of free cash flow in the fourth quarter. So the direction there is moving in the right direction. But the overall last year, they had some pretty substantial cash operating losses. Now, I would expect, they expect revenue to be down in the first quarter, and I would agree with that. But based on where they ended the year with their wholesale business, I would expect that overall revenue for them would probably be down a little bit in 23. They cut corporate headcount by 25% in January, and then they shut down or mothballed a handful of production facilities. So they expect about 35 million in cost savings this year. That will be a big driver of margin improvement. They're also cutting operations in California and Colorado, and they'll likely have shifts in revenue to more profitable states like New Jersey or Virginia, which will hopefully boost their margin. Liquidity for them is fairly tight. I mean, they ended the year with only 50 million in cash, and there will be some cash costs related to that restructuring that they did in the first quarter. I don't think it'll be anything close to 50, but it'll be in the millions. And they really do need to improve their cash flow generation in 23 and do what they did in the fourth quarter, kind of through the whole year. They will only be spending 15 million on CapEx this year, and they have a $6 million loan that they expect to pay off in the fourth quarter. So the cash outflows are really not that large this year. And they did have a maturity in a debt maturity of $38 million in May that they pushed to May of 2024. So, this is the year that they need to show that they can get the margins higher and that they can generate, cash flow. And, like I said, they need to recreate the cash flow performance that they had in the fourth quarter and replicate that all through this year to really get things going in the right direction.
Where does the Sean Combs deal come in? Because wasn't that related to like the merger completing? Has there been any talks about that, or no one knows?
No, if they can't get the deal done, if they can't close it, then no, unless they would opt to sell those assets on their own and not do it as part of the merger. But that was one of the bidders that came in to buy assets in New York, Massachusetts, and I believe it was Illinois. But then they had assets that they needed to divest in Florida, Ohio, and I think it was Maryland.
Yeah,
I could be wrong on the last state, but they needed to divest things in a handful of states.
Yeah, I'm trying to remember. Florida and Ohio for sure, but anyway, yeah, that's who they were coming in to help with the divestiture. But let's see.
Well, yep, we'll see. We shall see. Time will tell.
Yeah.
So we'll go to air. So air wellness. So big picture, I would say the asset base has not come together in the way that company is envisioned. In 2020, this is basically a Nevada and Massachusetts operation where they had like high 50% gross margins and EBITDA in the mid 30s, which is outstanding. Then in 2021 and 2022, they expanded into Pennsylvania, Ohio, Arizona, Florida, and Illinois. And while there were timing issues and delays, I mean, the asset base in the fourth quarter was at an annualized rate of about 500 million compared to the 800 million that they assumed that they would be able to get to about 18 months ago. And instead of an expectation they could do around 300 million in revenue, they only did about 100 million in revenue in the fourth quarter. So just broadly, not the thing that came together as they had expected. Now, Nevada productivity has waned with price pressure. The Massachusetts assets took some time to get operational, but the retail productivity in the Boston area has not been, what has been assumed. And I would say that's probably a comment on the flagship stores in the Boston area. In general, the productivity is not what I would have assumed for a city location like that. Now they acquired assets in Arizona that they acquired and built out. They opted to divest those. I bet the retail assets there were probably quite good because retail productivity in Arizona is high, but the cultivation investments never really amounted to anything. Florida has been a big growth driver because of cultivation investments, but their retail or unit productivity is pretty low, and they tend to be a little bit more aggressive on the pricing. So I would imagine their margin structure is lower than what we see out of peers in that state. New Jersey is going to be a bigger story in 23, but the asset, originally assumed, that cultivation would be a bigger part of that or wholesale, and that has not yet come together. But overall, I would say that they spent too much on buying the asset base, and they used a heavier cash component with those purchases that were, mostly funded with equity, but they also issued a lot of debt. And in 22, they did grow their top line, throughout the year, quarter over quarter. And they did have margin improvements over the course of the year from the first quarter to the fourth quarter. But for the full year, they were running at about a 19% EBITDA margin, which is about 9 points lower than what they did in the prior year. And while the revenue grew 30%, their EBITDA dollars declined by around 11%. And from a cash flow from operations standpoint, they had about a $35 million burn. They spent $60 million on CapEx. So their overall free cash flow burn was about $100 million. Now, I would expect that they would continue to grow their top line in 23 on retail addition in Florida and ramp in New Jersey. But they expect EBITDA margin in the front half to be around the low 20% range. And they think they can get to around 25% towards the back half of the year, with most of that improvement likely to come from G&A reductions, which they should have pretty good visibility into. For operating cash flow, they expect to be positive, and that will likely come from inventory reduction. They already closed on that Arizona divestiture, so they'll get $20 million in cash from that. And they still expect to spend about $30 million in CapEx this year, and they'll have about $40 million in debt repayments. So as long as they can improve their cash flow generation, I think this year should be okay. But in 2024, they have $300 million in debt coming due. So really the primary deliverable this year and into 24 is improving operating profitability, improving cash flow generation, paying down debt in an attempt to set conditions to either refinance that debt next year or retire a portion of it and refinance it. So that's really the key thing that they need to do this year.
Exactly. I was going to raise the debt piece, so that's a really good one to end on air.
Cool. So TerraSend. So TerraSend is kind of like Trulieve in that they're anchored in three states. For TerraSend, it's Pennsylvania, New Jersey, and Michigan. Pennsylvania went from being a business that was 2/3 of their revenue in 2020, and they probably had like 40% margins in the state, and they were the number one wholesaler in the state. I would estimate that their wholesale business between early 2021 and the fourth quarter of this year probably declined by about 80 or 90%, based on more of the operators in the state being vertically integrated and using more of their own supply rather than needing to buy it from Verano. They have a New Jersey business that has 3 adult use dispensaries and a wholesale business that really began to pick up momentum later in 2022, that likely has outstanding margins. They're probably in the 60% plus range for gross margin and probably 40% or better on an EBITDA basis in that state. So that's an extremely productive asset. But in the first quarter of last year, they acquired Gage in Michigan, and then they acquired some other dispensary assets in the third quarter. And when they did that, the overall profitability of that company just absolutely cratered. And this is kind of how it played out on a half-year basis from 2021 until now. This went from a 40% EBITDA margin business in the first half of 2021 to a 24% EBITDA margin business in the back half of 2021 as the Pennsylvania wholesale business declined. Then in the first half of last year in 22, that Pennsylvania business continued to shrink. And then they added these Michigan assets that were unprofitable that dropped the EBITDA rate to 8%. So they had like an 80% decline in rate over the course of a year. Now, by the back half of last year, New Jersey began to kick in. They cut cost in Pennsylvania, and the Michigan revenue began to improve with scale, and they got those margins back to 19%. But I mean, their margin rate has been like on a roller coaster, and they've not made it back to where they were at previously. In 22 overall, their revenue grew 24%, but their EBITDA dropped 44%. And with one, consistency between 21 and 22 being that their free cash flow burn was about $65 to $70 million in both years, which I would just say that's not a particularly inspiring performance operationally or financially, but I keep saying to be fair, I don't know if I'm fair, but they did do better in the back half, and they did generate positive operating cash flow in the back half, helped by deferred tax payments. But the other thing that was good with the fourth quarter is that they did improve their balance sheet. Yes. They did a debt refi, they did a debt pay down, and they converted some canopy debt to equity that reduced their overall debt by $80 million. And with a mortgage loan they're likely to take out and a little bit of debt pay down, I would think that their debt would go down a little bit more in the second quarter. In 23 and this year, they'll probably have high teens top line growth from New Jersey and Michigan that will be contributing for the full year. And then they acquired a dispensary in Maryland. They'll likely have wholesale growth in Maryland when that program opens up for adult use. And with restructuring in Michigan, they think they'll be around break even in the first quarter in that state. So the margin should probably improve from the high teens in the first half of 23 to probably something that's like in the low 20s later in the year. And CapEx is dropping to just $10 million. So they have a good chance actually of being free cash flow positive as long as they stay on top of their cost. And as long as Michigan doesn't come back to bite them, which Michigan might come back to bite them. But I think the last thing I would note on TerraSend is that they're seeking to do this TSX uplisting from the CSE, which is going from like a junior exchange to a senior exchange in Canada. It'd be like going from the OTC in the US to the NASDAQ. This could provide more liquidity. It potentially could provide for more institutional investment, and it could be easier to raise capital. But ultimately, the fundamentals are what matter most. And I think that I don't necessarily think that uplisting is going to be a silver bullet. That said, like I don't think uplisting will hurt, and if it actually does help and improves the liquidity and improves their access to capital, I'm sure that more MSOs will seek to do that reorganization and attempt to do the same thing.
Yeah, I think they did some really important work on the business in this last quarter, which now it'll just come down to operational efficiency on the go forward. So hopefully they'll start hitting their stride there. I do like their footprint in Maryland, and obviously New Jersey has been good for them. I'm curious if we'll see some pressure on Pennsylvania with what's going on in Delaware and these other markets adjacent, but that would be helpful to them if that did end up going adult use sooner than later.
Yeah, absolutely.
Do you think the TSX move, as it goes through, does that help with things in the U.S. on other exchanges? Like, is it a good, like, you could point to it if they're able to do it there, or is it just kind of on its own thing in a different country and completely separate and wouldn't move the needle here?
I don't think it would hurt, but we'll see if it could help.
Yeah, right. I guess
So,
that's the whole thing,
yeah.
right? It's
We'll
can't hurt, but yeah, how much does it help? That's the big question, just across the board with the TSX and TerraSend.
I mean, and just as long as if it creates liquidity and his stock can trade a little bit, well, it's already trading a little bit at a premium to his peers, or to their peers, but that does help them in the ability to do M&A, at a little more advantageous way with their stock, which has been really painful for people during this time when everything's been pretty torched. I don't know. It's just interesting because for a group like that who could stand to expand their footprint in some of these other markets more meaningfully, that's interesting. And Michigan is really an interesting state to watch. It's been very difficult for a lot of these operators because it's been much more like California than it has like New Jersey. But for the ones who seem to be getting their arms around it, there is growth there and there's opportunity for sure. You just have to be very, very wise on the back end, I think.
Absolutely. So why don't we wrap it up with Ascend? So Ascend last year, they grew their top line 22%, but they had a slight decline in gross margin, but they did, I think a good job managing G&A expense despite retail addition and stores that converted to adult use, which requires more people in the stores. Overall, their revenue grew, or their EBITDA grew 17%. So Illinois in 21 was about 80% of their total revenue, and sales in Illinois slipped by a few million, but New Jersey became a bigger part of the overall sales level there. But Illinois dropped to about 64% of sales last year. New Jersey, I would estimate, was probably about 75% of their revenue growth last year as they opened up with adult use sales in New Jersey, and they were able to get all 3 of their dispensaries open by December. They also had full year benefits from Ohio stores that were added at the end of 21. Their wholesale revenue was flat for the year, with gains in New Jersey and Michigan offsetting the decline in Illinois that was driven primarily by price compression. So EBITDA rate slipped by less than 1 point. They're at around 23%. Now they use sale leasebacks a lot, so their margins optically look a little bit lower than what Verano would be at 37%, and a lot of that has to do with the operating lease expense. But when you look at the trends on a quarterly basis, it moved in the right direction as they managed those costs well, and then they got that benefit from New Jersey as adult use opened up there. They started slow out of the gate in the first quarter. They had their EBITDA margins drop to 19%, but by the fourth quarter, they were back to around 25%. They had operating cash flow losses that were $40 million in both 21 and 22. They spent a little bit less in CapEx this year, but they still had about $120 million in free cash flow burn. Right now, they have 8 dispensaries in Illinois, and 2 of those are located just out of St. Louis. And we estimate that those two dispensaries do around 75 million in revenue, or they did 75 million in revenue last year, which was probably about 18% of their total sales. Now, those are incredibly high volume dispensaries, like anywhere. That Collinsville store probably did around 50 million in revenue, which for context, like a Lowe's, like a home improvement store, those big, gigantic box stores, those things do about 50 million in revenue. So the fact that they were doing this out of one dispensary it's pretty incredible. Now, those stores had about 40% of the revenue came from people that were Missouri residents. And in February, Missouri launched adult use sales. And pretty much like that, 40% of the transactions kind of went away. And they kind of knew that would happen, but it happened
fast.
It happened fast, yeah. And so right out of the gate, they about probably 7% of the revenue this year is at risk from losing transactions in those stores. And with price compression in Illinois, I would expect that Illinois is going to be a headwind for them this year. The offsets to that are going to be the operational assets in New Jersey that will be running under adult use for a full year. They added another dispensary in Massachusetts. Their wholesale program is doing better there, which is very unusual here in Massachusetts for people to say that our wholesale program is doing a little bit better, but it is. And then they'll likely get some growth from Ohio and Pennsylvania, where they just started generating revenue in the fourth quarter. So for 23, they guided to 15% top line growth and 15% EBITDA growth, which means they think margins will be roughly flat. I would expect that the gross margin would be down given price decline and given the loss of those high margin sales in Illinois. That would likely reduce their gross margin rate this year. So they're going to need to make up for that with G&A cuts in corporate, and those stores in Illinois. I'm sure they need fewer people to staff them, given there's less transactions going on there. So that would likely be another source of opportunity to cut their G&A. They ended the year with 75 million in cash. They'll likely require less working capital investment. So operating cash flow will likely be positive, and their CapEx is going to drop by about 70%. The only big outflow that they'll have this year, other than the CapEx, will be they expect to purchase 4 dispensaries in Maryland, which I think is about a $12 million outflow. And they potentially could get some sale leaseback proceeds if they can sell a facility in Pennsylvania, but that's not a given. But balance sheets are critically important right now. As we mentioned, they have $275 million in debt that comes due around mid 2025. So they have about 2 years before that matures to get the cash generation up, and that will be critical to getting that debt refied.
And they have an interesting model, Emily, you were pointing out with the outlet stores. And what do they have? 3 of them now?
I think so, because they've got the Pennsylvania stores and then the Southern Mass store, depending on the jurisdictions that they're in. I am interested to see what that looks like after Q1, since they'll have been substantially open for that time. And Pennsylvania was open last quarter, but I think Mass only opened this quarter. But as a kind of counterpoint to the promotional game or discounting game, and instead just saying we are a value-based retail outlet, and going that approach right from the start on some of these locations. I'm curious to see how that plays out in Q1.
Yeah, no one else is doing that, right? Like dedicated locations. Yeah.
No, I don't think so. And I think there's a lot of, from what I hear, there's a lot of fear around taking that approach. But
sure,
because it's like once you go there, that's where you are, I guess. Like,
right.
But I think it exists in other retail models, so it's an interesting strategy.
That everyday low price, or EDLP strategy, is one that you tend to get more consistent transactions. So what they're attempting to do is you want to be like a Walmart or a dollar store, where people go there very frequently because they know that the price is very consistent, and you don't have that high-low, mark it up or mark it down, type where you never know what you're going to get from a consumer standpoint, in terms of the pricing that they'll have. So, we'll see. Apparently that New Bedford store in Massachusetts is doing quite well, and it's not been open that long, but it's strong out of the gate. So we'll see.
It's a good point you make, Matt, too, especially for consumers who are, as a largely uncredit based consumer here, that has to actually use cash week over week for these transactions. And if you are trying to stretch your cash flow throughout the month and throughout the paycheck cycle, knowing kind of what you're going in and able to grab it's a model, and it's something to think about.
Wow. So that's the end of the list. And here we are in April, basically.
Yeah.
And you're going to be gearing up pretty soon here, right? Well, actually, Curaleaf is coming up. Do you know, is that coming up in what, matter of weeks? Did they give any guidance on that?
They didn't give a date
But
yet.
they
No
have
date.
to,
They're
right?
a little bit delayed on getting it.
For filing requirements.
I didn't see a date come across, but they said they'll get it done in
Yep.
April. So they did the IFRS to GAAP switch, and auditing is always a big pain to get done for these companies, and so they had some issues with getting that done in a timely manner, but they'll apparently be out in April.
We'll be waiting.
Yeah. Well, great. Comprehensive as always. Can't thank you enough, Matt, for all your insights here. I know our listeners just absolutely love it. It's just so packed with good information. So really, really thanks so much. And yeah, let's be sure we do it again next quarter. How do people find you if people aren't following you already?
Well, I'm not on Twitter, and you can.
I don't think many
Don't
people
find
are on
me.
Twitter these days.
Yeah, I mean, you can find me on the internet. I work at Needham Company, and that's we have distribution lists, and we publish notes on the space.
And then
Yeah,
disclosure.
fantastic. They're great notes. Yeah, way helpful to be able to digest all this stuff. So before we drop, Matt, I know you've got some disclosures that you've got to take care of, given the nature of the conversation here and the organization you work for. So you want to go ahead and do that?
Sure thing. Well, thanks for having me. And I do have to read my compliance disclosures. Needham Company is an investment bank that generates revenue from investment banking services and may be a market maker in companies mentioned in this podcast. Needham does not own any position over 1% in any of these companies, and I do not own, nor does any member of my family have any financial interest in the companies that we mentioned on this podcast.
Awesome. You got that thing memorized yet?
Nah,
getting there.
Why would you memorize a compliance disclosure?
Enough high rises and we'll get you there.
Yeah. Well, we hope you'll come back again next quarter, and maybe we'll have you on in case there's any special announcements in the future about just broader cannabis stuff. But I think you're giving ChatGPT a run for the money on doing the redux on these things. So thanks for all your hard work.
Okay. Well, thanks for having me.
Thanks for listening to the High Rise Podcast, presented by Headset. For more information on Headset, visit headset.io.